Well, as many people look to buy new homes, new cars, or take out loans, one of the important things to consider is, of course, that credit score. But there are lots of questions about what this means and what exactly can impact it. And here to tell us more, give us some clarity, of course, Megan Hammond, the Director of Financial Planning at WealthQuest. Megan, thanks so much for being here with us.
Thank you.
Okay, what exactly is a credit score for people who may not know, and why does it matter?
Yeah, so there are three major credit reporting agencies: TransUnion, Experian, and I am blanking on the last one.
I am too, because I tried it.
TransUnion, Experian, and Equifax.
Yes, there you go.
And so their job really is to gather information about your financial history, primarily around debt. And so they gather all of that and put together what's called a credit report. And that is then consolidated into a single number called your credit score or your FICO score. Now, each credit reporting agency is actually going to have a slightly different formula. So every person is going to have three potentially slightly different credit scores. But the numbers are from 300 to 850. The higher, the better. And really, this is an indication of what our future financial decision making looks like. So if I were to loan you money, what's the likelihood that you're going to pay me back and pay me back on time? So we can understand why that's really important when we're talking about mortgages or car loans or credit cards. But I think what a lot of people don't realize is that there are a lot of industries, a lot of companies and individuals that utilize information from the credit report for things that we might not even think of, like landlords and employers.
Right.
Insurance companies, even utility companies. And so it's really important for us to think about that and maximize our credit score as much as we can.
And what are some factors that can impact your credit score that make it go up or down?
Yeah, so there are 5 major factors. The most important is your payment history. So are you paying your debts and are you paying them on time? The types of debt. So do you have history with different types of debt? So car loans, credit cards, mortgages. The third one is utilization rate. So when you think about the total amount of debt that is available for you to use each month, what percentage of that are you using? So are you maximizing your credit cards every month, or are you using a small portion of that? The fourth one is the length of credit history. So how long have those different pieces of your credit report been open and active? And the fourth one are recent inquiries. So have you been applying for new debt? And if so, how recently? So those are the 5 big factors, but it's also really important to consider bankruptcies and foreclosures, maybe things that have gone to collections that are going to impact your credit report and impact your score negatively. So we want to minimize those or eliminate those as much as possible.
And the good thing about your score, it's not set, it can be improved upon. So if you're looking, you're saying, oh, my score is not where I want it to be, what can people do to enhance it?
Yes, I think the most important thing is knowledge. So know what's on your credit report. So each of those credit reporting agencies allow you to pull your credit report for free once every year. So I would encourage anybody to do that. Pull it every year from each of the credit reporting agencies and make sure that the things that are on there are accurate. Mistakes and errors happen more frequently than you would think. And so if you see something that's not accurate, make sure that you dispute it, because we want it to be as accurate for your specific situation as possible.
Yeah, and more than every year, there are so many different apps and even banks that allow you to see it on a regular basis, almost daily.
Yes, so you can see your credit score for sure. What you want to do is pull your credit report, which is going to give you the details of every debt that you have and the payment. So it's actually going to show you monthly what you've paid and if you've paid it on time. It's also a really great way to avoid fraud and identity theft, because you can see if there have been any inquiries in your account that maybe you didn't do. So that's really important. And I would also say consistency is going to be really important. It's over the long term. So make sure you make those payments and that you're consistent about the use of your debt.
All right, Megan Hammond with WealthQuest, thanks so much for being here with us as always.